Morgan Markets, let's start with you. We talk about central bank action. Tightening will persist, and there'll be greater pain for both equities as well as currencies.
Yeah, I think generally across the board, both in developed and emerging markets, there's only one way at this point in time, which is interest rates to go up. Of course, inflation is definitely a key concern for a lot of these, emerging markets, as well developed market banks. Inflation is at its highest, is over a generation. But I think at the same time, at the back of a lot of these policymakers' minds are essentially, the rate gap between the Fed and the central banks are just increasing. And what traditional monetary policy theory would suggest is that as this gap widens even further, we could see further pressure on the currencies as a result.
And how do you keep up? I mean, we had the central bank governor of the Philippines saying that, we don't want to match the Fed, but we have to respond. Therein lies the problem. I mean, how much do you respond?
Well, and I think it's a very, fair comment, and I'm sort of welcome to the world driven by Jerome Powell. The reality for most emerging market central banks right now is they have to make a very difficult choice. They can either choose to import inflation through a weaker local currency, or they can follow the Fed's lead. Or I guess the third option that we're seeing in Japan right now is to try to defend the currency, which we can talk about. But there's very little optionality at play right now. What's, I think, very interesting to watch, however, is the impact that is having on the domestic economy, particularly from a loan growth perspective, where you're seeing very clear differentials across particularly the Asian countries.
Let's talk about the yen. It is supported at this point in time, but some say it lasts for about 1 week. I mean, is there really reason to think the BOJ will continue to intervene, as some have suggested?
Well, I think it's fair to say, I think the general consensus, speaking to a lot of our strategists and traders out there, is that what the Bank of Japan has done basically just slows the depreciation at best. But I think a lot of people are still expecting the dollar yen to shoot up higher in the near term. I think Goldman Sachs has a call for 155. Again, they are really put in a tight situation because they are fighting against the king dollar, against surging U.S. yields. So unless they come in a very huge way, and even that's a big if, I think there is general concern or general uncertainty on whether they will be successful essentially in turning around the dollar yen.
What's your take on the yen? I mean, they have enough buffers. So what they did yesterday was pretty small.
Yes, and I think there's several layers to the conversation. The first layer is there is value in slowing the decline of the yen. It gives companies and people more time to react and more time to adjust contracts, processes, et cetera. So there is value in slowing the pace of that decline. Ultimately, fundamentals will determine the value of the yen, and the fundamentals are significant and rising rate differentials combined with a widening trade surplus. I think the interesting element of the yen conversation, at least from an equities market perspective, there are some quarters that will hold that a weaker yen is positive for Japan equity markets because of a strong export sector. I think that's a very antiquated view in my perspective, because what you've seen over the course of the past 15 to 20 years is the manufacturing moving outside of Japan and all over the rest of Asia. So the less relevant cross rate is not U.S. dollar yen, it's actually yen versus the rest of the Asian currencies. Now that's moved significantly as well, not as bad as U.S. dollar yen, but I think that's actually the area of focus in determining the strength of the Japanese economy, but also the strength of the Japanese equity market.
This question to Marcus. Marcus, I know we touched on the amount of treasuries that Japan holds. I mean, I think they're the second biggest holders in the world of U.S. debt. They've got the firepower, haven't they? The question is, do they want to use it?
Yeah, I mean, that's a big question in the market, right, essentially. But it seems at this point in time that, I mean, if there were genuine concerns that, Japan would sell down treasuries to basically buffer up its reserves, I think we'll probably have seen a sell-off in treasuries as a result. But I think at this juncture, most people are turning to the fact that Japan has, facilities with the Fed repo pool, essentially. And according to some Wall Street strategists out there, they put up a number of about $110 billion that they have. And, if you contrast it back to the, currency, we contrast it back to 97, 98, when Bank of Japan last defended the yen. They used about an estimated 42 billion or so. So I think the general feel right now is that Japan does not have to pare down its treasuries to defend the currency. They can actually use its existing repo pool with the Fed.
I want to just go to James now and ask him, with the yen where it is, there's got to be, if you believe that the yen does come back at some stage, doesn't Japan become a compelling equity question?
It can be. I think the question is the medium-term outlook on the yen. And as we've said, the fundamentals will determine that number, and that number is determined by what we expect to be rising rate differentials. We still have significant rate hikes penciled in the U.S., where JPMorgan's forecasting 4.5% by early next year. Previously, that forecast had been late next year. And we'll see where we go from there. The expectation is BOJ holds at current levels, which are obviously negative rates. And so as that continues, as the trade surplus continues to blow out, we do think we'll see significant yen weakness from a fundamental perspective. I think the key question here is, what is the Bank of Japan's actual strategy? Are they trying to peg the yen to a specific value, 140, 142, pick a number, or are they trying to make life a little bit easier for Japanese corporates by slowing the pace of the yen's decline? Very different strategy, very different funding requirements.
In the end, it is about monetary policy. The Fed has indicated that rates will come lower in 2024. That's a long way off. How do you trade that?
I think you have to be cognizant of what is in the price. And what's interesting, particularly in rate markets right now, is we have seen markets actually price in significantly higher rates than JPMorgan forecasts, as an example. You're seeing that in South Africa, you're seeing that in the UK, you're seeing that in select emerging markets as well. And so I think the criticality of this, again, from a market's perspective, is always what's in the price versus what we think reality is going to be. Markets are discounting mechanisms. They are overly doing their jobs in certain instances.
And Marcus, just before you go, what would be, I guess, ultimately the key driver for a decisive move in dollar yen?
Well, I mean, a few things. I mean, one of the obvious choice would be the fact that if there's a peak or turn around a dollar or turn around treasury yields, I think that would be a signal for the yen to rally, and not just the yen, but of course the broader DM and EM space essentially. But in other ways, other ways could be if the Bank of Japan decides to walk back on its yield curve control policy, which it does not seem a very likely action while Kuroda is in office in a sense. And I think these are some of the things that could signal a turnaround in a sense.